Welcome back to our series on accounting journal entries. Today, we're going to delve into the concept of prepaid expenses and how they impact the income statement and the balance sheet. We'll use an example involving Company ABC and their advance rent payment. Let's get started. On December 31st, Company ABC paid $60,000 in advance rent to its landowner. The payment was made for the month of January for the following year. So, how do we record this transaction in the journal? Let's start with the account column. We need to identify the accounts affected. In this case, we have the prepaid rent account and the cash account. Since the payment is for future expenses, we increase the asset account prepaid rent with a debit entry of $60,000. On the other hand, the cash account is credited with $60,000, representing the outflow of cash. By recording this journal entry, we are recognizing the advance rent payment as a prepaid expense, indicating that the company has paid in advance for future rent. Now, let's explore the impact of this transaction on the balance sheet and income statement. The balance sheet displays a company's financial position at a specific point in time. On the balance sheet, under the assets category, the cash account is decreased by $60,000. This represents the advance payment of the rent. The prepaid rent, being an asset, is added to the assets section of the balance sheet, increasing the total assets. On the income statement, however, there is no impact yet, as the expense has not been incurred. Now, let's fast forward to the end of January in the following year. We need to make an adjusting entry to account for the rent expense that has now been incurred. How do we record this adjustment in the journal? Since the prepaid rent has been used up, we decrease the prepaid rent asset account with a credit entry of $60,000. Simultaneously, we increase the rent expense account with a debit entry of $60,000 to reflect the expense incurred. By recording this adjusting entry, we are allocating the prepaid amount to the rent expense for the month of January. Let's now discuss the impact of this adjustment on the financial statements. On the balance sheet, the prepaid rent account decreases by $60,000, reflecting the portion of the prepaid expense that has been used up. Under the equity category, retained earnings decreases by $60,000 due to January rent expense incurred. As for the income statement, the rent expense increases by $60,000, reducing the net income by $60,000 for the period. And there you have it. Understanding prepaid expenses and their impact on financial statements is crucial for accurate reporting.